Silver just pushed through 91. First notice day is now less than 48 hours away. Shorts are visibly uncomfortable. Registered silver sits at 87.2 million ounces. Yesterday alone, 71 million ounces were rolled forward. Expectations of a March force majeure scenario have now faded. Shanghai futures closed at 104, spot in Shanghai at 100, western spot around 90. A persistent $10 premium remains. Gold closes at 5,185. The gold-silver ratio breaks beneath its 50-day moving average and now sits near 57. We are 2 days from March settlement, and market structure has decisively broken through resistance that capped price for several sessions. For those who follow charts strictly for educational purposes, not signals, resistance was identified between 87.20 and 89. Price achieved an hourly close above that zone, accelerated to 91, and has since retraced modestly toward 90. On lower time frames, structure remains constructive. The next technical objective stands near 92, with former resistance now acting as support. This is real-time structural analysis. It means identifying levels before price reacts, not drawing lines afterward. Watching how price respects predefined zones tells you more than reacting emotionally once the move has already occurred. Now, here's the data point that materially shifts the landscape. The amount of physical silver backing futures contracts continues to decline. Registered inventory now stands at 87.2 million ounces. Yesterday's 71 million ounce roll was the largest single-day roll we've seen in this cycle. Last month, force majeure speculation dominated discussion. Today's data suggests that immediate risk has subsided, the roll occurred, and price moved higher during that process, not lower. That is important. It indicates demand at these price levels remains firm. Open interest heading into settlement stands at 115 million ounces versus 87 million ounces registered for delivery. On the surface, aggregate numbers might appear manageable, but what stands out is the absence of significant new metal entering registered stocks, no meaningful replenishment. The longer that trend persists, the more constructive the backdrop becomes for silver over time. The reason we keep returning to this table is simple. If silver is to trade meaningfully higher into 2026, the driver will be sustained demand exceeding available supply. That dynamic can be tracked directly through warehouse backing levels, and current expectations are that backing continues trending lower. Here's how this sequence typically unfolds. First, we monitor spreads. March-May, then May-July, for a shift from contango into backwardation. When spreads flip, it signals near-term tightness. At that point, outflows from COMEX vaults tend to accelerate. Physical begins leaving the system faster. Then retail participants recognize that higher pricing is not a temporary spike, but a structural shift. ETF buying increases. That removes additional physical silver from circulation, compounding tightness. Earlier this week, another 1 million ounces were removed from registered stocks at COMEX. Available registered silver now sits near 87 million ounces for futures settlement. It's important to understand that physical silver inside vaults is not distributed evenly among participants. Therefore, it is incorrect to assume that if total open interest declines below registered inventory, all short positions are automatically safe. Distribution matters. Some shorts may still face delivery pressure even if aggregate totals appear comfortable. That nuance is often overlooked. Shanghai silver closed at 100. Gold closed above 5,200. Palladium gained 4.5%. Platinum advanced over 7%. Shanghai Futures Exchange inventory increased by 5.95 tons. Yet despite that, the Shanghai premium remains near $10, while Western paper pricing hovers near 90. That spread is not narrowed, it has widened. When physical premiums in Asia persistently exceed Western futures pricing, that signals structural imbalance rather than simple arbitrage opportunity. If it were pure arbitrage, the gap would close quickly. Persistent dislocation suggests deeper demand-supply friction. SHFE recently suspended additional trading groups for violations related to position limits. February alone has seen 25 groups suspended. Officially, accounts exceeded daily opening thresholds and breached trading regulations. Translation: aggressive size was being deployed. The exchange intervened. You do not suspend 25 groups in a single month unless positioning becomes extreme. Exchanges act when concentration risk increases. This matters because SHFE represents a major physical linkage point in the global silver ecosystem. Stress there is not merely paper volatility, it impacts global flows. When exchanges begin enforcing limits more aggressively, it usually indicates rising volatility risk, concentrated positions, liquidity stress, or potential delivery strain. These enforcement notices are publicly available. Verify them directly. Now let's discuss the gold-silver ratio. GSR has broken back below its 50-day moving average. It now sits around 57. When the ratio compresses from levels above 60 down toward 50, and breaks beneath moving average support, that signals a sustained shift in relative demand. Silver begins outperforming gold. Silver stops behaving like a chronic laggard and starts acting like a leadership asset. Silver recently touched 91.14. The 50-day moving average sits near 81 and has been rising consistently since late May. Importantly, the 50 MA has not declined during this advance. A rising moving average with price holding above it defines trending bullish structure, not a corrective bounce. Now zoom out. Mexico remains the largest silver producer globally. Recent disruptions matter. Silver has now been formally recognized as a critical mineral due to its importance in AI systems, electronics, and defense applications. Roughly half of U.S. silver imports originate from Mexico. U.S. economic models have examined scenarios in which supply disruption from Mexico affects GDP growth and national security considerations. Recent developments are concerning. Reports surfaced of mining company workers being abducted. Some were later found deceased. This makes recruitment more difficult for mining operations and increases security costs. Even prior to this incident, cartel-related violence had been escalating in certain regions. Transportation routes for silver are facing increased disruption and higher insurance expenses. It is premature to declare systemic collapse. However, risk factors are clearly rising. All of this occurs within a global silver market that has recorded supply deficits for 5 consecutive years, while COMEX inventories trend downward. The world requires silver. Its largest supplier is encountering instability. Coordination between U.S. and Mexican authorities may help restore federal oversight in affected regions. Stabilizing security conditions would strengthen economic integration. Given Mexico's resource base, particularly silver, it is in the strategic interest of U.S. leadership to encourage rapid stabilization through cooperation. Early signs suggest the situation may gradually calm. Historically, when cartel activity begins directly targeting high-value industrial assets, enforcement response intensifies. Mining infrastructure falls into that category. Let's introduce psychology. Daniel Kahneman in Thinking, Fast and Slow explains that under stress, human cognition defaults to System 1. Fast, emotional, reactive thinking, rather than System 2, which is slow, deliberate, analytical. The psychological environment surrounding silver right now, a settlement approaching, a persistent $10 Shanghai premium, multiple SHFE suspensions, and potential Mexican supply risks, creates stress on short positions. When stress triggers emotional covering rather than calculated risk management, markets can experience discontinuous price moves. That is when volatility spikes. Gustave Le Bon in The Crowd documented how group psychology shifts rapidly once participants recognize collective mispositioning. Individual rational thought yields to herd behavior. When 25 accounts are suspended in a single month, it suggests positioning had become sufficiently extreme to concern exchange oversight. Exchange intervention confirms imbalance existed. It validates that stress was real. Now let's evaluate the counterargument. 71 million ounces rolled successfully yesterday. That indicates roll mechanics are functioning. Force majeure speculation did not materialize. Settlement could conclude without incident if remaining positions either roll forward or accept cash settlement. The Shanghai premium could compress if Chinese demand moderates or if Western inventories are replenished. The Mexican security environment could stabilize more rapidly than anticipated. This is market structure education, not investment advice. Bottom line, 48 hours to settlement. Registered 87 million ounces. Open interest, 115 million ounces. Shanghai. Premium, $10 persistent. SHFE suspensions, 25 groups in 1 month. Mexico supply risks elevated. Gold-silver ratio breaking support. Technical structure intact. Force majeure not occurring. March pressure rolled, not resolved. The stress has not vanished. It has been deferred. Watch the next 48 hours carefully. Monitor CME warehouse data. Review SHFE enforcement notices. Track the Shanghai premium spread. Those who consistently do this homework understand the underlying structure as it develops. Not after headlines appear. Make decisions with logic, not emotion. Observe structure, not hype.